Welcome back to Nebula Trades, where we simplify complex trading concepts into actionable insights. I'm Apollo, and today we're diving into sector rotation, a powerful market dynamic that can significantly enhance your trading strategy. By understanding how and why capital moves between sectors, you can anticipate market shifts and position yourself for success. Let's get started. What is sector rotation? Sector rotation is a strategic movement of capital from one sector of the market to another. This movement is driven by changes in economic cycles, investor sentiment, and risk perception. By tracking these rotations, traders can better understand market dynamics and capitalize on emerging opportunities. Why does sector rotation happen? Sector rotation is influenced by several key factors. Economic cycles. As the economy moves through different phases, expansion, peak, contraction, and recovery, investors adjust their exposure to different sectors to maximize returns or minimize risk. Interest rates and inflation. Sectors react differently to changes in interest rates and inflation. For example, financials may benefit from rising interest rates, while utilities and consumer staples are typically sensitive to inflationary pressures. Market sentiment and risk appetite. Investor sentiment plays a crucial role in sector rotation. During periods of risk aversion, capital flows into defensive sectors, while in risk-on environments, growth-oriented sectors attract more investment. Types of sectors in rotation. Defensive sectors. These sectors provide stability during market downturns or uncertainty. They are less sensitive to economic cycles and offer consistent demand regardless of the economic environment. Key defensive sectors include utilities, essential services like electricity and water. Consumer staples, everyday products like food and household goods. Healthcare, pharmaceuticals, and medical services. Communication services, essential communication and media services. When positive gamma emerges in these sectors while remaining negative elsewhere, it signals a flight to safety, indicating a shift to defensive positioning. Growth sectors. Growth sectors outperform during economic expansion or periods of high investor optimism. These sectors are characterized by high earnings growth potential and are typically more volatile. Key growth sectors include technology, software, semiconductors, and digital services. Consumer discretionary, non-essential goods like retail and entertainment. Financials, banks, investment firms, and insurance companies. Positive gamma in these sectors signals strong buying interest and a risk-on sentiment, leading to more sustainable rallies. Cyclical sectors. Cyclical sectors are highly sensitive to economic cycles and perform well during periods of growth and expansion. These sectors include industrials, manufacturing, transportation, and infrastructure. Materials, commodities, chemicals, and construction materials. Energy, oil, gas, and alternative energy sources. These sectors show strong performance when economic indicators suggest growth, but are vulnerable during contractions or recessions. Interpreting gamma shifts in sector rotation. Gamma profiles provide insights into market positioning and sentiment within each sector. Here's how to interpret them in the context of sector rotation. Positive gamma in defensive sectors indicates risk-off sentiment as investors prioritize stability, often occurs during market downturns or economic uncertainty. Suggests capital is rotating out of high beta growth sectors into safer investments. Positive gamma in growth sectors reflects risk-on sentiment, with investors seeking high returns, typically seen during economic expansion or bullish market conditions. Suggests sustained buying momentum and support for market rallies. Negative gamma across multiple sectors signals increased volatility and market uncertainty. Market makers are forced to sell into weakness and sell into strength, leading to failed rallies and increased volatility. This environment often precedes sharp corrections or reversals. How to trade sector rotations. Risk-off strategy. When defensive sectors show increasing positive gamma, while growth sectors maintain negative gamma. Action. Reduce overall market exposure to limit downside risk. Tactics. Go long on utilities and consumer staples for stability. Consider pair trades. Long defensive sectors versus short high beta sectors. For example, short technology or consumer discretionary, long healthcare and communications. Risk-on strategy. When positive gamma appears in growth sectors like technology and consumer discretionary. Action. Increase exposure to high growth stocks to capitalize on bullish momentum. Tactics. Focus on leading sectors with positive gamma. Use call options to maximize leverage while managing risk. Sector reversal strategy. When A sector shift from negative to positive gamma after prolonged downtrend. Action. Position for a trend reversal within that sector. Tactics. Enter long positions as gamma turns positive and prices approach a significant gamma strike. Use option strategies to capitalize on implied volatility changes. Key risk factors to monitor. Sector correlations. Correlations between sectors may break down during extreme market events, impacting expected price movements. Monitor inter-sector correlations to adjust trading strategies accordingly. Macro events. Economic data releases, interest rate changes, and geopolitical events can disrupt normal gamma behavior. Stay alert to news catalysts specific to sectors in focus. Volatility dynamics. Sector rotations can lead to increased volatility, especially when gamma exposure is mixed across sectors. Use sector-specific volatility metrics to optimize entry and exit points. Why this matters. Understanding sector rotation allows traders to anticipate market shifts and adjust portfolio allocations accordingly. Identify which sectors are likely to outperform under different economic conditions. Recognize early signs of risk-off sentiment before it becomes apparent in price action. Implement more effective hedging strategies using sector-specific options. Sector rotation is a powerful dynamic that shapes market direction and volatility. By understanding how and why capital moves between sectors, you can position yourself more strategically and capitalize on emerging opportunities. This concludes another episode of Nebula University. Remember to stay connected with Nebula Trades. For more insights and access to premium data and an incredible trading community, check out www.nebulatrades.com, and don't forget to follow us on X at TradesNebula for live updates and market insights. For AI-driven analysis and cutting-edge quant strategies, check out at Telos Quant. Thanks for joining me today on Nebula Trades. Remember, trade the data, not the noise.